This tax-advantaged retirement account could be your set-it-and-forget-it path to becoming a millionaire. Hello and welcome to Practical Personal Finance, where you get the information you need to understand and succeed with money. There's a good chance that the company you work for offers a 401k plan. And if so, there's a good chance they've made little effort to explain how to take full advantage of this special account. So in the next few minutes, I'm going to tell you about what a 401k plan is. Then I'm going to help you understand how this special type of account works. And finally, if you stick around until the very end of this video, I'll give you my thoughts on whether or not you should take advantage of the 401k plan offered by your employer. The answer might surprise you. Let's start with the basics. What is a 401k? A 401k is a type of investment account with certain abilities that make it especially useful in your quest to save money for retirement. If your employer offers a 401k, you can deposit money into it to be used later in life when you're no longer working and earning an income. The name 401k comes from the part of the Internal Revenue Code that outlines how the account works. Section 401, subsection K. Yup, I went and checked it out. Pretty intense stuff. If you work for the government or for a non-profit organization, it's unlikely that you'll be offered a 401k. But you may have the opportunity to contribute to a 403b or a 457b. These other two accounts, again named for the part of the Internal Revenue Code that governs them, are very similar to the 401k. The primary difference is the type of organization that you're working for. If it's a for-profit business, you'll be offered the 401k. If it's not-for-profit or government, you'll be offered the 403b or the 457b. There are some other minor differences, but I won't be covering them further in this video. Now that you know the basics of what a 401k is and where the name comes from, let's talk about how the 401k works. I'm going to break this down into three parts: getting money into the account, helping money inside of the account grow, and taking money out of the account. First is getting money into the account. This part is fairly simple. You'll set things up with your employer so that a certain percentage of your paycheck is automatically deposited into your 401k. So on a very basic level, if your weekly pay was $1,000 and you specify that you'd like to contribute 10% of your earnings to your 401k, your company will automatically deposit $100 into your 401k account, and you would get a check or direct deposit for the remaining $900 minus any taxes or other deductions. You can choose to contribute as much of your earnings as you like, 10%, 20%, or even 100%. But you are limited to a specific dollar amount in a calendar year. In 2021, that limit is $19,500 per year if you're under age 50, or $26,000 per year if you're age 50 or older. The limits tend to change every few years, so if you're watching this video at some point in the future, do a quick Google search for 401k limits, followed by the current year to get some up-to-date figures. Regardless of how much you decide to contribute to your 401k, those contributions are 100% tax deductible. That's right, you don't need to pay taxes on the money you deposit into your 401k until later in life, when you're presumably no longer working and are therefore in a much lower tax bracket. More on that in a bit. As an example, let's say that your weekly pay of $1,000 from earlier was subject to 20% income tax. By default, $200 of your income goes right to the government. But if you elect to contribute 10% or $100 of your earnings to your 401k, your taxable income will now be just $900. As a result, you'll only need to pay the government $180 in taxes. That's a tax savings of $20 per week, or over $1,000 per year. The last thing you need to know about getting money into your 401k is perhaps the most important. It's called the employer match, and here's how it works. As a benefit to its employees, a business may elect to reward you for contributing to your 401k by depositing extra money on your behalf. So if you contribute $100, they might contribute an additional $100. That's a pretty sweet deal, because not only are you now getting a tax break on your contribution, but it's getting immediately doubled as well. There are a variety of ways that businesses will offer this valuable benefit. Some will match your contributions dollar for dollar, while others might only contribute 50 cents for every dollar you put in. Some might limit the annual match amount to 10% of your annual salary, while others might only match up to 5%. You might even have a plan where they match your contributions dollar for dollar up to 5% of your annual salary, and then contribute 50 cents for every dollar that you contribute after that, up to 10% of your annual salary. The possibilities are endless, and in some cases, confusing. So check with your employer and make sure you get a clear explanation with examples. Perhaps the best part about the employer match is that it does not count toward the annual limit I mentioned earlier. Even if your employer is matching you dollar for dollar, you can still contribute up to $19,500 as a 35-year-old in 2021. The match from your employer is just gravy on the biscuit. Now that you've got some money in your 401k, let's talk about how you can make it grow and make you a millionaire. By the way, if you're getting some value out of this video so far, let me know by giving it a thumbs up. Thanks. So your 401k works a lot like any other investment account. You can exchange the money in the account for other assets like stocks and bonds. The only difference is you're typically limited to a smaller number of investment options than you would be with a normal investment account. In a 401k, you may have just a handful of mutual funds to choose from. If you don't have a lot of experience with investing, or you'd like to make things as easy as possible, a target date fund, if it's available to you, is a solid choice. If you want to go this route, look for options with specific years in the title, and choose the one that's closest to when you'll be 60 or 65 years old. Easy as that. Over time, the money in your 401k will grow and begin to compound, and after 25 or 30 years of diligent savings, you might wake up one day and discover that you're now a millionaire. Alright, so you've saved, and now you're ready to start pulling some money out of your 401k. How does that work? Well, if you're age 59 and a half or older, you can start to transfer money from your 401k to your everyday checking and savings accounts. When you do, you'll get taxed on the money you withdraw as if it was your regular income. Except now that you're older and presumably retired, you'll be in a much lower tax bracket than you were previously. If you're still working and don't need the money, you can leave your 401k alone until you reach age 72. That's when you'll be required to begin making withdrawals to avoid penalties. If you're not yet age 59 and a half, you can still pull money out of your 401k, but it generally doesn't make good financial sense to do so. Because you're not of age, you'll be stuck paying income tax plus a 10% penalty on anything you withdraw. So if you pull $100 out of your 401k and you're in a 25% tax bracket, that's a $25 income tax hit and a $10 penalty, leaving you with just $65 in your pocket. Another option might be to take out a loan against your 401k, but then you're still stuck paying interest to use your own money. Not ideal. That being said, there are some situations in which you can withdraw early from your 401k without incurring the penalty, like in the case of financial hardship caused by medical bills. Let me know in the comments if you're interested, and I'll make a video all about early withdrawals. Now that you know what a 401k is and how it works, the question becomes, should you contribute to one if it's available to you? In my eyes, it all comes down to one factor: the match. If your employer is offering to match your contributions, then it's a no-brainer. Contribute as much as you possibly can, up to the point where you've taken full advantage of that free extra money. However, if there's no match, or you've taken full advantage of the match but you're still under the annual limit, I'd suggest taking a look at some other options, like a Roth IRA or a traditional IRA, before contributing more to a 401k. Here's the rationale. In a 401k, your investment options are going to be limited, and there will usually be some administrative fees involved. If your contributions are being matched, I can look past all that. But if not, I'd rather invest my money somewhere with more options and fewer expenses. For convenience though, it's tough to beat the 401k. Once you set it up, you've essentially automated your retirement savings. And if you're someone who's not feeling confident about managing a multifaceted retirement savings strategy, that's a good thing. even if it costs you a few extra bucks in fees. Does your employer offer a 401k match? If so, what's the percentage? Let me know in the comments. If you enjoyed this video and would like to learn more about the Roth IRA, click right here to watch a video about what I believe is the cornerstone of successful retirement savings. And if you're not yet a PPF subscriber, click right here to hop on board. As always, thanks for watching. I'm Andrew Shear, and I'll see you next time.